So for today's, I want to look at the USD S&P 500 Autocall being issued by Investec. It is currently in IPO on the standard online share trading platform. I've got a stripped down presentation from Investec, which we will run through with the T's and C's on it, and then we'll have a quick squiz at where it is on the online share trading platform. As I said, it is being issued by Investec, closing date 14 September. There might be a slight tweak with that on OST. We'll have a look-see when we get to there. If you've got questions, drop them into the Q&A box. We'll take them either at the end if they're not time-specific, or if they're to a particular point, we'll take them as they pop up. And the plan with this, it is a structured product. That is first and foremost what's important. It return in US dollars, although ultimately back into ZAR. Some complexity there, but I'll touch on that when we get to it. So what do we have? Let's go down to the bottom right. First, some risks. I mean, there is credit risk because it's a structured product. There always is. And basically your risks are Investec Bank and Royal Bank of Scotland. If either of those go belly up during the duration, you will join the queue. You don't get any dividends, and this is always the case with these, and it's part of how they do the funding in it. These products are sold net of fees, so there's no dividend to it, and the dividend essentially accrues to the issuer, Investec, and they take some of that for their fees in it. And you won't get more than 8% a year in dollars, plus whatever the ZAR has done. If the ZAR has weakened, you get more, and if the ZAR has strengthened, you'll get less. But you are essentially capped at an 8% per year. It's a 5-year maturity, and they've got an option to call it in year 3 or 4. And how that essentially works is that in year 3, which will be September 2023. If the reference index, in this case it is the S&P 500, if the reference index is green in year 3 at the anniversary, they will call the product and they will pay you 8% a year, 24%, regardless what the index did. You're going to get that 24%. If it is not green in year 3, they roll it to year 4. If in September 2024 the index is green over that 4-year period, they will pay out and it'll be 8% a year times 4 years, you'll get 32%. If it is red cumulatively over that 4-year period, they then push it to the 5-year period, which will be September 2025. If the index is green for the entire 5 years, whatever that green is, if it's only 1 point green, you'll get 8% a year. 5 years, you'll get paid 40%. If it is red, there is some protection to it. So if at the end of 5 years, as long as the index is not more than 40% lower, or it's 60% of where it started. So let's say that when they strike this in September, the index is at 1,000 points. In 5 years' time, as long as it is above 600 points, which is a 40% down, you will get your capital back. So you've got a capital protection, but if it is more than 40% down at the end of the 5 years, you then take the hit, whatever it is. That's important. There will be liquidity on the JSE. This is a product that is designed with a 5-year period. You're meant to hold it for the 5 years, or if it's called early in year 3 or 4. But in essence, what might happen is I don't know, something goes crazy. I mean, we're in a pandemic. Anything can happen. You can exit via the JSE. This is a JSE listed product. It will sit within your standard online share trading. It's a minimum investment of 100,000. Within online share trading, it is a minimum investment of 10,000. So it is equity return. You do get currency exposure. Sometimes that's removed, but you do get currency exposure, and you do get downside protection. Not absolute downside protection. That's an important point. You get, well, I suppose in essence you would call a partial downside protection, and it is net of fees. You put 100,000 in, they invest you that 100,000, or you put 20, whatever it is, they invest it. Now obviously there are fees being paid, but they are built into the structure, so it is net of fees. Here is some payoff profiles. Looking at 4 different scenarios. So the sort of dark blue line, market boogies along. What it does in the first 3 years is not important, but at the end of year 3, if the market is green, of the S&P 500, which is the reference index, if it is green at the end of year 3, they will call it and they will pay you 24% dollar return, plus or minus whatever the ZAR did. If we look at the light blue, it was at year 3, it was underwater. At year 4, it was underwater. And at year 5, it was underwater. But it's above that 60% barrier level, so you get your capital returned. Whatever you invested, you get the money back. If we look at the sort of light gold line, you can see at times it goes below the barrier level, but that's fine. But at the end of year 3, it's red, so no pay. End of year 4, red, no pay. End of year 5, the index is green. It is above the initial start level of the index, and you will get 5 times the annual payout, which is 8%, and you will then get 40% return. Notwithstanding, it might only have closed up 10%. You will get 40 guaranteed. Of course, it might have closed up 70%. Well, you only get 40. And the fact that it was below the barrier is not important. If we look at the sort of darker gold line, you can see it's been all over the place, but at the end of the period, it never at year 3 or 4 was green. So what happens is it goes to ultimately year 5, and at year 5 it is below that 60% level, so the market is more than 40% down, and you then take that capital loss. So these autocalls, in some senses, they're very different. That they certainly are, and they're a little bit tricky. But basically what it means is that at the end of year 3 and 4, they check, and if the index is green over that period, they then call it, and they pay out 8% per year that it's been running. So if it's green at the end of 3 years, they pay out 24%. If it's not green at the end of 3 years, but it is green at the end of 4 years, they'll pay out 32%. And if it wasn't green at year 3 or year 4, at year 5 it is green, they will pay out 40%. And if it's red but not 40% down, they will then give you money back. And if it's more than 40% down, well, then you take a capital loss. So you've got protection in a sense, and you've got some potential upside, gearing, but of course you might end up giving up that upside. Fred, would you get 8% per year, i.e. 24, 32 at the end of year or 3? Yeah, that is correct. So it is 24 at the end of year 3, 32% at the end of year 4, and 40% at the end of year 5. So it does. It's absolute. So it's 8% per year. You're getting 8% per year that it pays. Charman, surely the RSA retail bond is giving the same growth with less risk and lower minimums. Certainly lower minimums. I haven't checked the RSA retail bond as to what the growth is, but it quite possibly is, and your capital is obviously protected. But what you don't get is any currency exposure in that sense. And I'm going to come to the currency in a moment. But yeah, if the RSA retail bond is giving you 8% a year, and your money is guaranteed, and you lock in for a 5-year window, and I think that is what it is offering, then you're in the boat. Absolutely you are. In essence, they're different products. It's payoff profiles. And what you're getting here is you might cash out earlier, and they'll give you a new one rolling forward. The key difference here to an RSA retail bond would be, quite simply, that you also get currency exposure. And let's look at that right now. So a number of scenarios here. I'm not going to run through all of them, but let's look at the impact. So the 100,000 investment, and we've used a rate of 1650 just for illustrative purposes. 100,000 is just over $6,000. And let's say the second line here, at the end of year 3, the index return is 10%, so there's an automatic call. The index is up 10%, automatic call, you get paid 24%. So your dollar return is 7,500. But if the rand has moved, you actually to 18, it's 7,500 times 18, and you get that kicker of rand weakness. If the rand's gone to 15 at that period, you'll get paid $7,500 at 15 to the dollar, and essentially you, instead of getting a kicker, you get kicked. You take some of the shine off that process. And that's what I mean by you also are getting that currency exposure. So you're going to get the currency exposure. If the rand weakens, it will enhance your return. And if it strengthens, it'll take sort of shine off the return. Because what Investec is doing is they take your ZAR, they turn it into dollars, they then use the S&P as the reference point, and so it goes. So at year 3, if it wasn't anywhere, it just continues to year 4. In year 4, if it's still down, it just continues. If in year 4 it's green, it pays you out 8% a year, 32%. In year 5, if it's down 25%, you get your capital back. So you get 0% back. You get your $6,060.60 times whatever the currency is. You get your capital. You might still end up with a capital loss, 90,000, or a capital gain, 109,000, depending on the rand move. If it's up 25% over the 5 years, you're going to get 40%. Again, rand strength will take some shine out. And if it's down 42%, you take that loss because it's more than 40% down at the end of the period. And again, your investment is $3,500 from 6,000 and change to 3.5. The rand, depending whether it's weakened or strengthened, will determine how you then get paid. So you've got the two moving parts in a sense. Another point coming through. Yeah, so there's a fair point. You hold this to the duration, you're going to be paying CGT on it. You get a 40,000 exclusion. Your retail bonds obviously are paying interest. There's a 24,000 exclusion a year, and thereafter you are taking the tax issue. S&P 500, I think this is probably a very well-known index. It's a market cap-based index, 500 constituents, listed in the USA, the largest stocks in America, the 500 largest. And it's all your well-knowns, your Facebooks, Microsoft, Amazons, Apples, etc. What I note here, if we look at the top left, the split between is that tech has been sitting in the low to mid 20% for a while, and it's currently sitting at 25%. Financials were sitting at around the sort of 16 to 18%, but after obviously the sell-off that we've seen in 2020, financials have dropped to only 11%, and in fact healthcare is now the second biggest component of this index at 15%. Those components obviously will change over the years, much like in any others. There certainly are the issues going through. Kenneth, I'll come to yours at the end. So the minimums, Investec usually rolls them at sort of the high net worth. Some of their offshore ones are 100,000 US. As I said, there is a deal with Standard Bank clients where we get a slightly better minimum. Investec went and did a whole lot of back testing, period 2000 to date, so some 20 years of back testing, and 70% of those observations would have received in the first call. In other words, after 3 years, it would have been you get paid out. So typically, over any 3-year rolling period, over the last 20 years, the index is green over a 3-year period, and you therefore get paid your 24%. Green after, if it's not green after 3, in some cases it's green after 4% after 4 years, and then obviously if they did not call, or 5-year auto call, so a quarter of the time you get it at the end in 5 years. At no point over the back test. The next back test is lacquer, but back test, past performance is not indicative of future performance. But a 20-year period, which includes the dot-com collapse, includes the 2008, 2009 crisis, etc. So there's been lots of volatility in the market. At every point, the index was never 40% down over a 5-year rolling period. And that's important. So, it might happen, but the odds are slim. And likelihood is it'll auto call after 3 years, pay you out 3 times 8, 24%, plus whatever that particular currency move might be. Closing date 14th September. Trade date will be 21 September. In other words, that will be the date that they set the various different levels. And then it'll list 29 September. And ultimate maturity 21 September 2025. But there will, of course, be a call on 21 September 2023. And then, of course, 21 September 2024. Investec is not giving any tax advice on it. But broadly, the issue is typically what you expect from this. You've held it for 3 years. SARS will consider this to be of capital gain in nature. It's also, although you are getting exposure to the offshore, it's not part of your offshore allowance because you buy in ZAR and you receive capital back in ZAR. There is no option to receive capital back in dollars. You will only get money back in ZAR. Question coming: why not just go and buy one of the S&P 500 ETFs? 100%. I mean, the key distinction, of course, is you don't have downside protection, and you don't have, the market's only done, say, 10% in 3 years, you might clock in 24%, or so there is some upside enhancement, there's some downside protection, but as a long-term investor or someone who's maybe wary of markets or something, there's some benefits compared to a sort of vanilla S&P 500, and there's some pros. What if the market's up 30% in year 3? You're going to get 24. What if, so there definitely are some swings and roundabouts. On balance, I think for a cautious or perhaps a nervous investor who's perhaps worried about returns or collapses in prices, then perhaps you are better off in something like a structured product. In terms of fees, Kenneth, yep, fees are being charged. Fees get paid, obviously, to parties all over the place. Standard Bank gets a fee. I think that's 175 points. Investec, etc. But the numbers that we quote here are net of fees. In other words, you drop 10,000 in, they take it as 10,000. The fees are paid from, for example, you've given up the dividend environment, so fees are taken from that and other places. Let's go to online share trading quick. So it is sitting on the online share trading. You can see it there under the special announcements. Okay, so I'm in a tax-free account. I can't subscribe. Let me just move out of a tax-free account. There was a question coming through. There's your Standard Bank fees. There's a total fee to Standard Bank of 125 points in year 1 and then 75 points thereafter. So a couple of, of distinctions here. Standard Bank, you need to have applied by Monday, 14 September, 8 a.m. So that is Monday next week. You need to have put your application in already. And Standard Bank's got a minimum of 10,000 as opposed to the 100,000 Rand minimum that if you go direct under normal circumstances. All the stockbrokers question coming through, will other brokers be offering it? Yeah, I mean, this is a product, it's JSE traded, so all stockbrokers will have the option to offer this product. It's not all of them have the reduced application fee, but essentially it'll be exactly the same product across the array. And in essence, the process is quite simple. Select the account you're looking to invest into, put the amount in within the rules, which is 10,000 minimum, 1,000 thereafter, hit the application, and it'll trigger off, and you will receive as the dates, they strike it on the 21st, and it'll appear in your account on the 29th. Marsha, you didn't understand the exiting early. That's fine. So what they're going to do is they will enable you to exit the product during the period before it's called. So, in the first 3 years, and if it's not called in year 3 or 4, during the entire duration. What they're going to do, however, is when you're exiting, basically it's going to trade like an S&P ETF. It'll be the level multiplied by the so the level multiplied by the currency. So you'll exit, but you won't get the enhancements and you won't get the protections from it. And there's going to be a 0.5% move on the other side of the spread, which then I see someone saying, well, could I buy it during the period? No. So Investec is on the buy side only. Someone else might put an offer in the market, but Investec is on the buy side only. Nope, you can't put this into a tax-free account, structured product, but the legislation around tax-free account is you're not allowed to do any enhancement in terms of return. You can do it in terms of downside protection, but you can't do enhancement in return. So in essence, you can't put it into a tax-free. It needs to go into a normal vanilla account. Correct. Fred, you do not receive the dividend distributions during the period. No dividends are paid, and that's partly how Investec funds the fee. Because what Investec, in essence, is doing is they take your 100K. They, in part, go and buy some of the ETFs, but they've also got to, there's costs in terms of currency conversions and the like. They've got to put a put structure in to give you that capital protection, and then they've got to do a call structure to do that enhanced trade on the upside. So there are no dividend payments, and that's fairly standard on structured products as we see them. Marsha, I think this is the slide that you are referring to. So in essence, they've given us 3 scenarios. So in year 3 and 4, there's only going to be one of 2 scenarios. Either the index is green over the period, in which case it calls and it pays 8% per year that it's been in existence, or the index is red over that 3 or 4 year period, and then it rolls to the next period. If it gets to year 5, and if we look at the back testing, it tells us that it only gets to year 5, sort of a quarter of the time. If it gets to year 5, then there are 3 potential scenarios. If the index is green, it'll pay 40%. If the index is red, but less than 40% red, it pays back your capital, $6,060.60, multiplied by the exchange rate. And if it is more than 40% down, you take the capital loss, and then you take the exchange rate process in there as well. Why the difference? So the trade date is when they effectively set the date. So closing date is Monday 14th, and that's when Investec now knows, all the brokers send off all the docs, etc., through to Investec. They then set the levels on 21 September. So they will take the level of the index on 21 September and the level of the ZAR at 21 September. They then structure that product. They need to list it via the JSE and all of that process, and it will start appearing on the market. Its effective listing date is 29 September, but the start and therefore maturity date will be 21 September in each period. Question, could you go direct to Investec? You could, but you would need to go to Investec stockbrokers. You can't go to Brian McMillan and his team. You would then need to go direct to it's a JC product, so you need to go via a stockbroker. So if you were going direct to Investec, it would be a case of going directly to Investec stockbrokers, which is then going to be exactly the same process as going through standard online share trading. Of course, Investec stockbrokers, a 100,000 minimum rather than the 10,000 at Standard Bank. Could you buy it for a minor? Sure. I mean, if a person has a JC stockbroker account or JC FSP financial services provider account, any account there can buy it. That's absolutely not a problem. The restriction is you can't buy it in warrants accounts, you can't buy it in derivative accounts, and you can't buy it in tax-free accounts. You buy it in a vanilla account. Looking for the brochure wares. I thought there were links to them here. Curiously, I don't see links to the brochures. Drop me a mail. I can send you the brochure. Simon@justonelap.com. I can forward you the brochure if you wanted for more. So there should be a link here. I'll point out to Standard Bank that they haven't got a link. Nope. Unless I'm blind. No, I'm not blind. It really isn't there. Okay. No, I'll alert Standard Bank, but if you want to drop me a mail, I can send it to you. Yeah, I mean, if you are massively, if you're bullish on the market, if you think that 8% a year for the S&P over the next 3, 4, or 5 years is going to be easy, and quite frankly, the S&P's long-term average is slightly ahead of 8. You don't need any protection. You're like, what, if the market falls, that's fine. The market will recover. Then absolutely, this product is not for you. If you're sitting here now and you're perhaps worried about markets, you think they're expensive, or perhaps you're worried about another correction or something, then this is the sort of product for you. So, if you're absolutely guns to the wall and bullish on the market, then no, then this is not something for you whatsoever. Cool. Ladies and gents, not seeing any further questions come through, so we will park that there for now. Appreciate everyone's time this morning. We'll be back Monday with Dineo. Everyone stay safe and have a great weekend. The sun is out. It's looking like a nice spring weekend. Cheers all.